Despite fears of a trade war, rising interest rates, political uncertainty around midterm elections in November, renewed currency concerns, and questions around future growth prospects, the U.S. equity market has been steadfast in its ascent. Right now, strong economic growth, impressive corporate earnings, and a wave of share buybacks are providing the tailwinds necessary to keep the bulls firmly in control. Happy birthday to the longest bull market in U.S. stock market history, but is it the greatest? Brian Dietrich, senior market strategist at LPL Research, points out that the 1990s bull market saw the S&P 500 index gain 417%, while the current bull market is up roughly 320%. So you can't call this the greatest bull market in percentage terms yet. The key question investors of all types will ask is, when will stocks run out of steam? Up until this point, technicians and analysts can quantify everything from intraday stats to long-term trends, but figuring out when it will turn is an exercise in futility, as anyone timing the market can attest to. No doubt the ride higher has been anything but smooth. Dietrich notes there were two significant corrections along the way. In fact, using a 20% correction as the end point, this bull market almost ended abruptly not long after it began. At its intraday lows, the S&P 500 corrected more than 20% in October 2011. The index ended up rallying off the lows and closed down just 19.4% from the previous high. So although most don't consider it the end of the bull market, some may say that it's a technicality. A few years later, the peak in May 2015 until the lows in February 2016, the S&P 500 dropped 14.2%, and since that low, the S&P 500 has not looked back since. With the markets trading around all-time highs as recently as this month, the bull market is almost certainly set to become the longest ever tomorrow. What does that mean for investors? Ivan Feinseth, Chief Investment Officer at Tigris Financial Partners, believes the U.S. stock market continues to be extremely resilient and will outperform versus other developed and emerging stock markets. Feinseth thinks the strength is being driven by the fundamental narrative, most importantly with strong corporate results in the second quarter following the first quarter. Gains in stocks are further being driven by increase in dividends and share repurchases, positive trends in the U.S. economic data, and a moderate leaning toward accommodative Federal Reserve. From the Nasdaq MarketSite in Times Square, I'm Jill Malandrino, Global Markets Reporter at Nasdaq.